Welcome to Srihari's lessons. Hope you enjoy your time here. Continue listening and supporting. Hello friends, let us in this chapter discuss about the different time frames generally operating in the money making process. Also, let us look at different aspects or tools used in analyzing and deciding which instrument suits you at what time in money making process. Hope you have listened to previous chapters and keeping continuity. We have touched upon in earlier chapter about surplus accumulation, that there should be goal-based planning in the process of making money. Refer chapter 7 video if required. We have mentioned there about planning time frames in your accumulation journey. We are going to detail the same a little bit more here. When you are fixing return expectation and the risk involved while choosing your instrument, planning the time frame is equally important and critical. Similar to returns and risk, time frame planning is also different for different instruments. At this moment, we shall look at general time frames involved in money making process. As a normal behavior, any prudent person shall not expect exorbitant returns. Same way, any prudent person shall not expect very short turnaround for money. Same way, waiting for inordinate long duration also leads to inappropriate results. In general parlance, people tend to define time frame split as short term, medium term and long term. But it is not easy to quantify at this juncture what is a short turnaround and the normal turnaround, or what is short, medium and long term. Generally, this varies from instrument to instrument and also from circumstance to circumstance. There are numerous time frames possible to generate money. There are trading time frames as low as 1 minute. That is, you buy this minute and sell the same next minute. At the same time, there are time frames as high as 20 or 30 years or so. For one instrument or one circumstance, this 1 minute transaction can even be a long-term category. At the same time, for one instrument or one circumstance, even this 30-year transaction can be classified as short-term. What I am trying to convey here is that the definition of time frame is entirely dependent on the instrument and circumstances present. Remember, time frame is one of the most important of the three elements along with returns and risk. This is because your time frame shall have sufficient influence on fixing expected returns and identifying risk involved. In future chapters, when we are discussing individual instruments, we shall look at time frame possible for each instrument. Now, as a second part in this chapter, let us look at different aspects or tools required in analyzing, in choosing instrument and fixing these three elements of risk, returns and time frames. This again, as we often repeat, shall be different for each instrument. This can be broadly classified as macro events and micro events. On one aspect, global or international news and reaction can be called a macro event, and against that, a national or state level news and reaction can be called as micro event. Another case, an industry level news and reaction can be called as macro event, like automobile sector. Say against that, any news or reaction pertaining to an individual company can be called as micro event. For example, an automobile company like Hyundai or Maruti. We have repeatedly mentioned basic concepts of demand-supply mechanism works on almost all financial aspects in this world. Most times this is understood and analyzed by using statistical tools and charts. Reading a chart and using a statistical tool is a skill. There are courses to teach this skill. However, beyond what is taught in these courses, the basic purpose or objective of using these tools and charts is just to understand the effect of demand supply on a particular instrument at a particular point of time. This macro and micro level news and reactions, along with understanding demand supply effects through statistical tools and charts, are the basic level analysis in order to choose the instrument and fix return expectation, risk involved, and plan your time frames. This is mandatory for every decision made in one's financial journey and accumulation journey. These are not analysis done just at the start of the process alone. One should at a very low level, basic level, keep in touch with all these analysis as long as you need to stay in one instrument. This actually shall not take much time or effort once the concept of this is understood clearly. We have strongly said each individual is different and each different instrument shall suit different individual. If you are unable to track all this analysis for any of the instrument, it is quite easy to avoid that instrument and choose an instrument that is suitable to that individual. There are so many numerous options available, and hence none of this should really hamper the financial journey. As we discuss each instrument in future chapters, we shall cover events, news and reactions along with micro or macro classification and using appropriate statistical tools and charts for each instrument respectively. With that, I'll close this. We will see you in the next video. Thank you. Welcome to Srihari's lessons. Hope you enjoy your time here. Continue listening and supporting.